So we just had what I feel is incredible earnings for SoFi stock, but of course, Wall Street seems to have a massive problem with SoFi. So are their concerns valid and there's a big problem for SoFi stock, or is this just more of Wall Street garbage and we need to be gobbling up the stock as much as possible? But let's take a look at what Wall Street's saying, and I'll give you guys all the answers to those questions right after you hit that like button if you like getting the truth without the hype, because that's what you're going to get today, guys. The election chaos flash sale is live, where you get my complete SoFi bull and bear case. You can see all my buy alerts on SoFi in real time, get my complete watch list with price targets to include SoFi. Everything else, guys, there's so much involved, free coaching, everything else. Just check out the pinned comment down there. We'll talk more about that at the end of the video. But we need to get into Wall Street because, of course, Wall Street is back at it again. And right now, the narrative around SoFi is just borderline ridiculous. So let's see what they're saying, and we'll get down to the truth, and I'll tell you exactly what I think, exactly where they're wrong, exactly where they may be right as well, and some things that we need to be concerned with, and kind of tie it all together into what I think about SoFi moving forward.
Welcome back. Time for Under 30. Today, looking at SoFi. Joining us now, George Tillis, Senior Markets Correspondent for the Schwab Network, to help us break down the numbers and the reaction. George, stock's under pressure, but it does seem, if you're looking for a silver lining, if you're a SoFi bull, holding on to that $10 mark after breaking through there, it does look like buyers were ready and willing to jump on that dip. What's going on, though, with the numbers? Like, you look at them, it doesn't seem like they were all that disappointing.
Yeah, we had a bunch of members jump all over it when it got down under $10. It was very, very brief there. Yeah, shoot, I was busy working on something else, so I wasn't able to grab shares personally, so I missed out. I know we had a lot of group members that I'm sure a lot of you guys out there were doing it as well, obviously, because the earnings were great. And there was just, I don't know what the heck Wall Street's thinking. Anyways, let's see what the guy says.
Yeah, they weren't. I mean, if you break it down, I mean, just the numbers alone, we've talked about this company quite often in the past. And I mean, for all intents and purposes, if you look at the stock since July, it's actually had a really nice run. So if you look at the numbers, 5 cents came in on an adjusted basis versus 4 cents estimate. The sales number came in higher than estimate. It was higher by close to 30% year over year. They raised guidance for earnings. They also came in, by the way, with not only a beat on sales at $697 million, but they came in with a net income profit, in this case, of $61 million. And we've talked about the problems.
Yeah, so right there, before I let him get into the problems, that's a typical quarter for SoFi. That has been going on now for... somebody in my group was saying 17 quarters in a row now. I don't know if it's quite that far, but I know we're well above 10 quarters in a row now where we've seen that sort of performance where not just small beats, big beats, and raises, virtually rinse and repeat every single quarter for a long, long time now. Every single quarter is improved for years now at that stage. That is called execution on a very, very high level. And to be surprised by that at this stage is still kind of funny to me, because they've just, if you're paying attention to what this management team's doing, they're clearly executing on a very, very high level. So, but anyways, I'm sure he's got something here that'll make sense, right? Yeah.
Has had in the past. And one of the problems has been the fact that if you go all the way back to 2017, prior to this quarter, at least on a full year basis, they haven't been profitable. So they're moving in the right direction. So I think
number one way that you know that you have nothing on a company is when you have to go back so far to where it doesn't even make sense. SoFi in 2017, was a completely different company than SoFi is today. Not even close to the same type company, different streams of revenue, different profit levers, different everything. Now, a lot of that was forced on them. I agree that may not have been the original plan. But that's basically like, a company selling, I don't know, tacos, and then all of a sudden they pivot to pizza and trying to compare the taco numbers to the pizza numbers when the pizza numbers are hitting it out of the park. But, back when they used to make tacos too, the numbers weren't so great. So, it's just kind of like, apples to oranges or tacos to pizza, whatever the heck you want to call it there. It becomes ridiculous at that stage. You've got to take from when they made the significant shift and pivot and kind of move the numbers forward there, because it was no longer that business anymore, the student loan processor giant that it was prior to that. Still a component of the business, absolutely. But for right now, if you've been counting on that for, I don't know, really 3 years now, you've gotten zip from that line of business. So the company should be dead if they would have stayed in that direction, that type business, more importantly. It'd be a dead company right now. Instead, we're profitable and increasing profitability, increasing growth at an incredible pace. That right there is why if you got to go back that far in order to prove a point that, well, they're profitable, but if you take into account full year and you go back to 2017, okay, yeah, I guess so. Let me just judge what, any company's doing, that Microsoft's doing now versus what it did in 1987 and try to draw the correlation there. Or Amazon, hey, back when they just sold books online, and then try to compare it to now, and try to draw some sort of comparison to kind of knock on Amazon and what the beast that they are today. Because back when they were just a book company, they did, these things. And it wasn't as good back then as it is right now. It's just silliness at that stage. But let's keep going here. I'm sure this gets a lot better.
This is the reason why perhaps the initial sell-off earlier in the day has been bought back up. There is still quite a bit of short interest in the stock, around 17% of the float. This may be a little bit of a short covering, but for all intents and purposes, one of the problems that still exists, in my view, for SOFI, which has been growing its customer base, it's growing its products, it's growing its technologies across the board, from investments to insurance, starting out having been, originally a student loan company. It's providing private banking and all sorts of investment services and insurance services, mortgage services. So it's becoming more of a comprehensive technology company as well as a finance company in tandem. But right now, based upon these numbers and figures and the expectations of further profits going forward, right now, I think the problem still lies in valuation.
Okay, so I'll stop it right there because there's two things I want to address. First, the short interest. I don't care. I'm going to say this, and it's going to upset some people. I don't care about short interest, short squeezes, or anything else. There has never been in the history of the stock market, not once, not one time has it happened where shorts kept a stock down forever and the stock just never went anywhere, while basically the company performed and continued to increase profits, increase revenue, increase everything, and shorts just held it down forever. Never happened in the history of the stock market. I don't care about shorts. It does not even enter into my calculus in regards to that. Second piece of short interest, I don't care about short squeezes either. Could care less, couldn't care less, however the heck you say it, for those of you guys that are correct my grammar down below. I know it's not good. I don't care. Short squeezes are stupid in my opinion, and to bank on a short squeeze, unless you're trading. Now, if you're trading, totally different. I totally understand. But this is a long-term buy and hold channel, and I'm not interested in a short squeeze because it forces me to be a trader. Sorry, SOFI is not worth $20 today. It will be in the future, in my opinion. It is not worth that today. And if it were to go on a quote-unquote short squeeze and run up to 20 bucks, now I've got to think about truly taking profits, because now we really have poured forward a few years worth of profits into today. And that sucks. That is not a situation I want to be in. So I don't want any sort of short squeeze of any sort. They're rare that they happen on these huge levels that everybody likes to pump up on YouTube and everything else anyway. So they're just utterly ridiculous to even think about. They don't happen the vast majority of the time. And even when they do, there's all kinds of levers and mechanisms, not only in the market, but in regards to what the hedge funds can do that are short to kind of get themselves out of the sticky situation too. But nonetheless, that doesn't make for good YouTube comment. It doesn't get you lots of, likes and whatever. So therefore, people continue to put out those videos. I don't care. It doesn't even enter my calculus at all. And unfortunately, if it got caught up in a run, I would be, upset. And I'd be coming on here making a video, probably depending upon how far it went, saying I had to sell a stock because this is just stupid. And then, of course, I had all people, oh, you're bearish, you're this, that. No, it's same thing when Tesla was at 400. I almost decided to sell it whenever it was at 400 because it was just stupid. It was at 1,000 PE, and I knew it was going to trade down for a period of years, and that is exactly what happened. And I know that's what would happen if SOFI went on some utterly ridiculous run. Not the run it's been on right now, an utterly ridiculous run moving forward. That right there to me would just be absolutely not devastating, but it would definitely make me not happy as a long-term buy and hold investor. Second piece, he sat right there and just named off all the great things about SOFI that they're doing, and they're at the beginning of all those sorts of things. And oh yeah, by the way, all those things, or most of them, are very high margin, very profitable products, which of course means more money coming to the bottom line. And he even called them, more of a, basically fintech is essentially how he ended up categorizing them. Even better. But now he's going to say there's a problem with valuation. And I wonder what he's going to say the valuation problem is. That's a mystery. He just laid out the case for why it's more of a technology company, more fintech. But yet, I wonder what he's going to say in regards to valuation here and why we have a valuation problem. So this should be interesting.
Just consider the adjusted earnings for the remainder of this year. They did increase it by a penny. It's close to 12 cents now versus 11 cents. and about 26 cents for next year. It's trading at around 103 times forward earnings for this year, as well as about 44 times next year. Now, again, the issue really had been in the past, and I say the past because it seems like it's a turnaround story here for SOFI, so this may be a promising and continuation play, is it hadn't been profitable, and it's actually been increasing its share count substantially. If you just go back to where it was in 2017, the share count had increased by 25-fold, but its revenues had only increased less than 5-fold. And
just for reference here, that is literally the story of virtually every single public company whenever they go public. Literally the same exact story. And it's comical. Same thing with all the people talking about stock-based comp with Palantir. And they wouldn't buy Palantir because their stock-based comp is just out of control. I was laughing. I heard that for 3 years now. Okay, some people still believe it. It's like, okay, please go look at Apple or any legacy tech company's balance sheet. Go look at NVIDIA and how many millionaires they have run around that place right now because of stock-based comp. Then they issue it like crazy, just like everybody else does as well. It is very, very much the part of the journey with any publicly traded company, but yet it becomes a bear narrative for some reason. And for some reason, people believe it or believe it's an anomaly, and somehow SoFi is doing something different than every other company at the same exact point in the growth curve that other companies are at. And it's just simply not true. And again, he had to go all the way back to 2017 to make a point that I don't really believe has any relevance in 2024, more importantly. So anyways, we'll let him keep going here. I'm sure it gets better.
Being is it has had to finance that net loss for so long and grow its capital base in terms of technologies and product offerings. It may have found an inflection point. So I think that's why they're buying it up today. It comes down to it was a profitable quarter from a net income standpoint. Guidance was raised, and even going forward, they're expected to continue to be profitable in the next year. So it basically lessens the pressure on issuing of shares because they don't need to issue as many shares, and that share issuance is decelerating or slowing down. But the problem may still lie in the volatility because of the valuation. And just to give you some context on valuation, I'm just going to use the 2024's PE of 103. If you look at PayPal, which is a payment processing technology company, that stock is trading around 17 times forward earnings. If you look at JP Morgan, which we all know is a major international commercial depository bank, is trading around 11 times forward earnings.
So he kind of decided to go with two companies that are not anywhere in the same ballpark as SoFi in regards to where they're at. Two legacy companies. We've been talking about here on this channel, PayPal is still undervalued today based upon valuation, significantly undervalued. The forward multiple of 17. Yeah, that multiple should be up closer to mid-20s to 30. So it's significantly undervalued. Is it at the beginning of the growth curve like SoFi is? Does it have the amount of annual growth coming? Alex just guided, single-digit growth in the fourth quarter. I don't believe that they're going to guide to 30% growth next year. PayPal is what I'm talking about there. No chance. Neither is JP Morgan, for that matter. But yet that's what SoFi is guiding for. Or SoFi could guide for. I guess we'll see what they guide for next year. But the point being, we're not even comparing apples to apples there. And you're comparing it to JP Morgan, who's a legacy bank, who is a completely different, like I wouldn't even call those remotely in the same ballpark in terms of competitors and in terms of where I would compare a multiple. If I'm looking for a multiple for SoFi, I would be more inclined to look at maybe Square, maybe somebody like that in regards to multiple, not JP Morgan of all people. And even if you wanted to go PayPal, which is kind of in the same space, PayPal is definitely legacy and not early in their growth curve like SoFi is. So how much more of a multiple do you give SoFi versus PayPal? And also keep in mind, PayPal is also undervalued. Now, in regards to where SoFi's valuation is, we'll talk about that one here in just a minute here at the end of the video. In regards to where it's at in terms of the curve, it is not as undervalued as PayPal is right now today. Now, whenever you were giving it to me at $6 just a couple months ago, yeah, all day long, happy to buy it. Obviously we were buying it back when it was in the fours. So most of my position was built out in kind of that $4 to $6 range or so, right up in there in regards to all the shares that I own. But just a couple months ago, you could pick it up in that $6 range again, which of course the valuation would have been significantly smaller. And you also got to remember when you're talking about multiples going forward, whenever a company just turns profitable, they haven't been profitable for all that long, that PE ratio is always really, really high. That multiple is always really high at the beginning until you get some profitable years underneath your belt to where you get a more consistent and a more steady multiple at that stage. So they always trade high right there at the beginning regardless, because you just turned profitable, and a lot of the numbers all have to adjust over the next few quarters. Just the way that works. This guy knows that too, but he's trying to make a point, and I just felt like he made a very poor point at best, trying to make this dramatic difference, and obviously trying to push it down for whatever reason. Hey, I'm happy to buy, by the way, if he does.
The problem still lies with SOFI is it's expensive on a forward multiple basis, but the profitability profile is improving, which is meaningful.
Yeah, I noticed that because, as you mentioned, within the quarter, they beat across a variety of metrics. It seemed to be that payment trends were improving, the charge-off rate was improving. Would those be viewed as tailwinds, though, outside of today?
I think so. I think that anytime you reduce the charge-offs and improve your credit allocation and credit quality, that manifests in a better earnings profile on a forward basis. Plus, they're still expected to grow revenues in the high 20% range. So, trailing revenues about 30%, still forward revenues at 28%. I talk about this all the time with Alex and Jenny. Irrespective of revenues decelerating, that's fine, as long as it's being made up and accelerating earnings growth, which seems to be the case for SoFi.
And George, a stock's run a long ways in a hurry when the CEO of the company flat out says, hey, our stock's down today because it went up 40% in the last month. That doesn't happen all that often from the leadership of the company.
Yeah.
And hey, they're probably right, to be completely honest with you. But hey, George Tillis, appreciate it as always, senior markets correspondent.
All right, so we'll talk about SoFi valuation here in just a minute and all that other good stuff. Hopefully that gave you some insight in regards to how people are kind of twisting themselves a little bit, trying to create a narrative that's not really there at this stage. If you guys have not seen the Bloomberg interview yet with Anthony Noto that he just made shortly after earnings there, go watch that. That right there will lay out why I believe there is a fintech multiple there in the future for that company. Go watch that. But in regards to valuation for SoFi stock right now, it's run up massively. And if you wanted to call it a little bit overvalued, okay, I could definitely buy that because that makes sense after that kind of a run. And of course, given the fact that earnings are coming in the future and we're kind of at the beginning of that earnings curve, that right there can make sense. But when I start to look out a year, 2 years out, it still looks good right now in regards to that. Now, in regards to your plan and what you should do, that's where you need to learn valuations. You need to learn how to do all that sort of stuff. Of course, we teach that in my group there, but that may not be right for you. I'm okay. I understand that. But that's right there is where that's key, and understanding where the stock is going long-term and understanding the business itself long-term. Now, where is it going to go in the meantime? I don't know, because it's trader controlled still. It has not been profitable long enough for there to be a lot of institutional investors coming in and buying. That's increasing every quarter, but it's not enough yet to take it out of the trader's hands. So, hey, a run up wouldn't surprise me. A beat down, back down, under $10 again, wouldn't surprise me either. But in regards to valuation, we're definitely more on the rich side right now. That doesn't mean it's not a buy. Again, especially with just the way they beat and raise and they beat and raise and they beat and raise. I don't know. Undervalued, overvalued becomes undervalued really, really quick. Of course, outside of some stupid, Wall Street bets type run up or something like that. The stock's in a great position, but more importantly, what matters most is earnings performance, and that is what they continue to do solidly quarter in and quarter out. So if you don't know how to do evaluation, you want to get intimate with that. You want to see my 2-year price target, bull and bear case for SoFi, where I break it down, what multiples I use to get there, exactly what will happen if Wall Street gives it one multiple, Wall Street decides to give it another multiple. Remember, guys, we don't control that. Wall Street does. They control all that. And you want to see my buy and sell alerts in real time, get free coaching, get access to 5 courses for free, and so much more. Make sure you take advantage of the election chaos sale that is going on right now. It's just a flash sale real quick here to kind of get us through this election time frame, to get as many of you guys in as possible to help you out with all that. So make sure you check out the pinned comment, take advantage before that sale ends and the price goes back up. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.